lot of echoing.
That's pretty good. At least I don't hear any.
We okay?
Are we good? One moment.
Sure.
Working perfect.
We're good to go, Dr. Wagner.
Great. Good morning, everybody. As you know, we're meeting by electronic means, and thank you for attending. And we're doing this as permitted by Virginia law during the state of emergency. You know, that was declared by the governor because of COVID-19. This will be held in an entirely open session, and we're being live streamed and recorded, so you know we're on the air. All votes taken today will be done by roll call vote. How about that? Madam Rector, was that okay? Is you good with that? Good, great. Hi, everybody. Good to see you. So I think you folks have in front of you what our agenda is for today. We're going to talk about the external reports from KPMG. I have to tell you, I got a preview yesterday, and you know, we've got a great organization. Oh my goodness, great folks, and I think you'll be very pleased with the information they have to provide. So I think I'll just do what I'm supposed to do, and that is hand over to KPMG.
Well, thanks, Dr. Wagner.
Thank you.
Good morning, everyone, and thanks for having us here today to discuss the results of our fiscal year 20 audits of EVMS's consolidated financial statements. We'll attempt to move through the materials with pace, but obviously, to the extent you have questions as we do move through the materials, please feel free to speak up. You would have received our materials via Diligent, and I'm sure a lot of you are following along either on your computers and iPads. Also hyperlinked within Diligent are 3 draft documents for your viewing pleasure. They include the consolidated financial statements themselves, our required communications letter, as well as our internal controls letter. So my name is Trey Oglesby, and I'm your lead engagement partner. With me virtually on the line today, we have Nick Strong, who's a senior manager in our Norfolk, Virginia office and leads our team at the manager level. Nick is one of many people, both on the KPMG as well as the EVMS side, that have worked diligently over the last few months in order to allow us to discuss these results here with you today. So I'll begin on slide number 1, which is, it's really intended to give you a sense of how we strive to provide an exceptional client experience to EVMS. Paramount to everything that we do is the execution of a high quality audit. And we have a system of quality controls that facilitates that. But it's also predicated on the experience of our team. We have a team that is highly skilled not only in the professional standards, but also in our firm's audit methodology and how to apply that to EVMS. Our team utilizes IT automation in our audits to efficiently and effectively test certain financial statement captions, journal entries as an example. And our team also spends nearly all of their time serving not-for-profit, either higher ed or healthcare clients, which really puts us, you know, I believe in a unique position to provide insights as well as assess accounting and financial reporting issues in a more effective and efficient way. So moving from there to slide number 2, I just wanted to highlight on here that, look, this has been a challenging year for all of us. Obviously, we're not together here today to discuss these results. We're meeting virtually, and the health and safety of our EVMS as well as KPMG professionals is very important to us. And we were able to coordinate and pivot our teams to best work together in a virtual environment. And I think did that fairly seamlessly. So I would also add that our audit approach has been responsive to any new risks that were a result of the pandemic. So moving on to slide number 4. As of today, our audit is substantially complete, and with the receipt of the rep letter, which we now have in hand, as well as approval by this committee, we'll be prepared to issue an unmodified opinion on the consolidated financial statements of EVMS, which is the highest level of assurance that we can provide. As we've discussed in the past, EVMS records a beneficial interest in the assets of the EVMS Foundation because the two organizations are financially interrelated, but EVMS does not control the foundation. Now, if you control the foundation, then that would necessitate consolidation of the foundation. But because you're simply financially interrelated, you record that beneficial interest. We've also discussed in the past that the foundation is audited by another auditor, and our unmodified opinion will highlight that to the users that EVMS Foundation is audited by another auditor. EVMS's significant accounting policies are disclosed in Note 2 to the consolidated financial statements. All other disclosures, including those related to significant accounting policies, were found to be neutral, clear, and consistent year over year. Nick will go through we'll go through two of your significant accounting estimates as well as risks here in a moment, and how our audit procedures are responsive to those risks. But those include your allowance for contractual adjustments and uncollectible accounts, as well as your management override of control. So the allowance for contractual adjustments and uncollectible accounts, that really resides down at the med group level, and there's a standalone audit that's completed by another KPMG team over the med group. But because the med group is included or consolidated to EVMS's financial statements, and because of the material nature of those estimates, they're also deemed to be a significant risk at the EVMS consolidated. Any questions so far? Hearing none, I'll move on to slide number 5. There were two new accounting standards that I would highlight that were adopted by EVMS in 2020. Those were related to the contribution standard, as well as the presentation of restricted cash in your statement of cash flow. Nick will discuss those and their adoption in a little more detail in a moment, but what I would say as an overall comment is that our opinion did not change with respect to their adoption. As a result of our audit, there were no material audit differences, whether that be corrected audit differences or uncorrected audit differences that we are required to report to you today. And secondarily to that, there were also no control deficiencies that rose to a level that we have to bring them to governance attention. We're not aware of any subsequent events that would be required to be disclosed in the financial statements, and through the course of our procedures, we did not identify any legal acts or fraud, that we would obviously bring to your attention. Moving on to slide number 6, I would just say that the communications at the top of this screen are all the positive ones and the ones that you really like to have. For example, there were no disagreements with management, and there were no difficulties encountered in executing our audit procedures. 2 at the bottom that I would bring to your attention: we're required at least annually to confirm our independence to EVMS, and we're here today to tell you that we are independent of EVMS. And then second to that, as part of our audit procedures, we do make certain inquiries of governance as part of the audit process. Those inquiries are included on slide number 13. I won't go through each one of those, but to the extent any matters need to be brought to our attention, please do let us know. So at this point, I'll pause one more time before I continue on with the presentation and see if there's any questions. Again, hearing none, I'll ask Nick to go through our identified significant accounting estimates as well as risk and how our audit procedures were responsive to those.
Thanks, Trey. So here on slide 7, during our audit plan presentation, we had communicated that there are 2 significant risks that are present in our audit. The first is just described here, and it pertains to the medical group's allowance for patient receivables that are expected to be uncollectible. So we deem there to be a significant risk present in the account because inherently the allowance is an estimate and it uses historical data to predict future outcomes. And there's always a risk that historical results won't be the best indicator of the current day environment, such as a COVID-19 environment. The medical group has a separate KPMG audit team that performs testing over the allowance directly with management of the medical group. And through our discussions with the medical group audit team, the allowance remained relatively flat, actually decreasing a bit due to lower patient volumes in Q4. Another positive factor is a large portion of AR is due from the federal government through Medicare and Medicaid programs, which carries little to no risk of collectability. AR from large third-party insurance companies may have taken a bit longer to collect in this environment, but ultimately it carries little risk as well. So we concur with the medical group's conclusion that the allowance is materially stated. Slide number 8 details the second significant risk present in our audit, which pertains to management having the ability to override controls. So due to management's unique position within the organization, the auditing standards define this risk as being present in all entities, regardless of size or industry, and they require auditors to design procedures in consideration. So one of the procedures that we have designed is employing data and analytics to assist in identifying journal entries posted throughout the year that may be indicative of higher risk. For each entry that meets our high-risk criteria, we will examine the supporting documentation to determine whether the entry is appropriate and follow the proper review protocols. And there were no instances of management override or fraudulent entries identified through our audit procedures. Moving on to slide number 9, there were 2 new accounting standards that became effective this year and were adopted by EVMS. The first is ASU number 2016-18, restricted cash, which was adopted retrospectively. And it now requires restricted cash to be included within total cash on the statement of cash flows, whereas restricted cash was previously excluded from the statement of cash flows entirely. The FASB's thinking here was, well, the purpose of the statement of cash flows is to allow the reader of the financials to understand the ins and the outs of cash that occurred throughout the year. So previously, the exclusion of restricted cash wasn't providing that full picture to the reader. The second standard that was adopted this year was ASU number 2018-08, contributions, which management adopted using the modified prospective method. And this standard was established by the FASB to reduce diversity in practice by further defining how not-for-profit entities should account for grants. And it involves determining whether the grant meets the definition of an exchange transaction or a non-exchange transaction. So to offer an example, tuition revenue, that's very clearly an exchange transaction between EVMS and the student, right? So EVMS receives payment of tuition, and in exchange, the student receives an education. That exchange that takes place, that represents commensurate value from the student's perspective. An example of a non-exchange transaction would be a state appropriation, right? So the state contributes funding to EVMS, but the state isn't really receiving direct value in return. Now, of course, one could argue the state is receiving value in the form of EVMS's programs benefiting the general public, but that alone doesn't constitute commensurate value when compared to the tuition scenario. So albeit immaterial, where the standard did have some impact was with private sponsored research grants. So certain grant agreements do contain language in which the sponsor retains rights to research findings or intellectual property. And in these cases, that would be enough to be deemed commensurate value. But outside of this immaterial change in classification of grants, the standard didn't have a major impact, and it did not introduce any new disclosure requirements. Any questions on those thus far? Slide 10, this is our final prepared slide for the presentation. So with our financial statement audit now complete, we'll be commencing the uniform guidance audit in November with management and the assistance of internal audit. And consistent with our audit plan that we shared with you back in March, we've selected student financial assistance as the major program for testing. Our intent is to be in a position to issue that report before the holidays in December, but the ultimate deadline is March. So if that time is needed, you know, there's plenty of additional time. With that, Trey, I'll turn it back over to you to take us to the end.
Yeah, I mean, any questions? We're going through stuff. Hearing none, you'll see towards the end of our prepared materials, there's another supplemental communication section. This really gives you a little more clarity or detail around our independence communication, as well as the inquiries which I previously spoke about with respect to governance, and as well in a forward-looking lens to next year, certain accounting pronouncements that will be effective for next year's financial statement audit. So, you know, in conclusion, I think these are, it's a very positive audit this year, very positive result. It wasn't without its challenges, not only implementing new standards, but, the complexity and how, the teams interact relative to the pandemic and working in a completely virtual environment. And what I would say is I really want to thank, the folks in your, finance and accounting shop, from Vicky to Camille to Helen to, Margaret, like the whole bit that have been involved significantly, down to, not as significantly, and the people below them as well. It was, in my mind, it was a very positive and productive audit experience, all things considered.
Well, Trey, thank you very much. The floor is now open for discussion. Anybody have any questions, any thoughts? Anything to add at this point? I have to tell you, we have a world-class team, and it's great for you guys to validate that. Thank you very much. Hearing no further discussion, I'd appreciate a motion and a second to approve this year's audit report as presented.
Motion.
Second.
A motion.
I have a motion on the floor. Is there a second?
Second.
Well, there's a second. Now, there we're going. Time for roll call vote. Please, Heidi.
Yes. I'm going to call through the ones that I know are present. There was one who joined, and I cannot see them on the screen, so there'll be one that we'll have to catch here at the end in just a second. Dr. Wagner.
Aye.
Dr. Emery.
Yes.
Ms. Goodwin.
Yes.
Mr. Hart.
Yes.
Dr. Martin.
I think that was a muted yes.
It was a muted yes. Okay. And then there should be, I don't know if you were able to pull up the list of who joined. I can just go through the names of the others as well. Is Admiral Bianchi on the line? I think so.
Yeah.
Is Miss Bishop on the line? Right. Mr. Lewis? Dr. Waldholtz?
Dr. Waldholtz is on the line, yes.
Thank you, sir.
Welcome.
That's everyone.
And the report of the vote is?
We have 6 yeses.
6 yeses, no abstentions, no against. The motion passes. Thank you, everybody. And once again, thanks to the folks at KPMG and again to our world-class team. I think it's time for Ms. Helses. Helen, it's your turn.
Great, thank you. I also want to echo everybody's comments about the team, and I just want to express my appreciation for everybody coming together. It was challenging to do the audit this year and shift to a remote type of environment, and they got it done and got it done on time. So I want to express my appreciation, especially to Vicki Dean, our controller, and Camille Andrus, our new Associate Vice President of Finance. With that team together, I was less involved this year, so that was great. So I did want to go through the financial results. They are very similar to what was presented at the September board meeting. We didn't have very many adjustments after the September, what we reported in September, with the exception of some changes in the insurance that just increased our insurance reserves that we report in department reserves. So in your package, there is a financial highlights section, and I'll pull that up. Okay, so this is in your package, and this is the balance sheet and income statement. It is in a little bit different format than what we present throughout the year, but I will go through some major variances. Again, these are all very similar to what we reported back in September. So cash and cash equivalents increased $17.6 million. This is due to the increase from operations, less, which was $53 million less, $46.3 million in capital construction projects, and net of depreciation of $9.7 million. So most of it is just from the general operations net of the capital expenditures. Our accounts receivable, that increase, this is mostly timing from tuition and sponsored programs. We see this alter year to year based on when we do billings for those two components that are pretty steady year to year, but the timing of when we get them and when we bill them changes, so it causes this fluctuation. As well as we did a billing to the state at the end of the year that was outstanding at June 30th for capital projects, so it was for Waitzer Hall. Okay, I'm going to go down to D, the accrued compensation increased almost $3 million. This is mostly due to the physician, physician compensation. This is the 70% component of the clinical margin. You may recall we get 20% that goes to core, 10% goes to department reserves for chairman's fund, and 70% is available for non-salary physician compensation. And so that gets recorded as a liability at the end of the year, and then it is distributed in the following year as determined by the chair of the department. The deferred income had a decrease of $2.3 million. And this is mostly due to tuition, deferred tuition revenue, and is offsetting the decrease in tuition receivable that I just talked about. There is also about $800,000 in deferred income from the money that we received from the CARES Act from the state. So at the end of the year, we received $1.6 million, of which we had expended through June 30, $800,000 for COVID-related expenses, and then the remainder will be spent from July through December 31st. So that is in a deferred income category, because if we cannot apply it towards COVID-related expenses, we will have to return it to the state. I do fully expect that we will be spending that, by the way, and we have approval to spend it through December 31st. Okay, so the income, I'm going to go flip down to the net asset section. Department reserves increase. This is similar to what we saw at the end of the year, and there's a schedule in the detail here that describes where the majority of the increases occurred. This is similar to what we reported in September, with the exception of that one entry for insurance reserves, which increased the insurance reserves by a little less than $1 million that we recorded at the end of the year. The net investment in plant category, I here, letter I, in these two things, these get combined. This large increase is due to the Waitzer Hall construction. So we are receiving contributions from our state appropriations from the state to fund that capital expenditure. So that is increasing our net assets. We will see that decline as that asset gets depreciated over the next 30 years. So are there any questions on the balance sheet? Okay. And here are the notes that are accompanying the schedule that are in your package. Okay, so the income statement, this is a totally different perspective on what we compared to what we report throughout the year. Throughout the year, we generally report the income statement as a budget to actual variance. And so we're looking comparative information as compared to budget, whereas this at year end, we report a comparative to the prior year. We also do not report throughout the year this temporarily restricted column. This is where we have activity for our state appropriation for the Waitzer Hall. So in fiscal year 20, we received reimbursement for construction of $33.7 million. This is a large increase from prior year, which has generated that $17 million increase year over year. And that's due to the timing of when we had the construction. Other sources increased $2.8 million. This is mostly due to revenue sources in the medical group, and it relates to the PSPP revenue that they received. You may recall that the PSPP revenue that they went up this year because they did the formula different after COVID, as well as an increase. They received some coronavirus relief funding from the feds through the CARES Act, and so that's $1.4 million that was not recorded in fiscal year 19. Down to expenses. The undergraduate instruction had a large decrease, but that is due to the intergovernmental transfer that was recorded in fiscal year 19. So that was a one-time event. That was almost $43 million that we recorded that did not recur in fiscal year 20. So that generated the large decrease. The research expenses went down $4.4 million. This is due to the decrease in the Conrad program. This was budgeted and this was expected and this was reported throughout the year. And it is offset by federal revenues up in the top section, so it does not have an impact on our bottom line, but it does reflect down in this section as a decrease in expenses. And then lastly, unrealized gains and losses. Down in this section, these are reported in non-operating. Throughout the year, we report these up in operating, but at year end, in accordance with GAAP, they are reported down as a non-operating item. And the fluctuation is just due to the change in the market value of an investment that we're holding. We had a larger gain last year than we did this year. And then same with the change in the interest of net assets of affiliates. This is where we record our interest in the EVMS Foundation. And the last year had a significant increase. That was $22.2 million. It's much larger than what we would normally see. And then, so this year comparatively there's a large decrease, but that's because this year is more normal activity. So the good news is our change in net assets is $21.4 million for unrestricted and $33.3 million for total restricted, for an increase of $54.8 million for the year. So that's how much our net assets increased throughout the year, which is a great accomplishment, especially in this environment. So we are very happy with these results. And I don't have any additional comments unless anybody has any questions.
Helen, it's Marcus. I just had a question. Let's see, I understand the contractual services difference 2020 and 2019, about $60 million. IGT, I think, is responsible for majority of that, correct?
That is, yes, well, actually, under contractual services revenue, that relates to the amount from the Centera affiliation agreement that we received. So last year, we received, between the CMAQ funds, and then they also provided an additional one-time support of $11 million that we did not receive. So that was the $60 million, at least it was, I think, $62 million that is not in the normal course of business.
And so for undergraduate instruction, that was about 40-some million difference.
Yeah, that was $43 million that was paid for the IGT. Yes.
IGT. Okay. That was it. Thanks.
Any other questions for Mrs. Celius? I tell you, we've had a great year. Our staff and our leadership have really overcome some tremendous diversity, but I've been quoted as saying you never want to let a good crisis go to waste. Great work, everybody. The floor is open for any conversation or any other comments.
I just want to say thank you. It's really great work, and it's encouraging in these times. So thank you.
Our president, provost, and all the other hats that he wears has done a great job. Thank you very much. Got a great team, and the team has executed flawlessly. Really great work. I think that takes us through what we have as a formal agenda. Does anyone have any other new business to discuss, or are there any other issues at hand? Hearing none, I'll take a movement for adjournment.
So moved.
Motion?
So moved.
So moved. Do I hear a second?
Second.
There's a second. And the vote is, I think everybody says aye. Well, I'll say aye. I'll say bye. Take care, everybody. Thank you very much for your engagement and your assistance. Have a fabulous rest of your day.
Thank you very much.
Congratulations to the whole team.
Yeah.
All right,
Thanks,
thank
guys.
you.
Have a great
Thank
day.
you. Good weekend, Paul. Thanks.
Bye-bye.
Bye.